If you own an interest in a partnership, you may wind up being exposed to IRS tax liability even for years you didn't own the business. I'll explain how. Well, that's because the IRS has fundamentally changed how partnerships audits now work. Under the Bipartisan Budget Act, the IRS now audits partnerships centrally and may assess tax directly against the partnership itself. This changes who controls the audit, who pays the tax, and who carries the risk. Hi, my name is David W. Klasing. I'm a dual licensed tax attorney and CPA, and for nearly 30 years, I've helped taxpayers defend against IRS partnership audits, complex business examinations, and on occasion, criminal tax investigations. The BBA partnership audit regime creates new risks that many partners still don't fully understand. And to tell you the truth, many representatives don't get it either. So, what has the BBA changed? Before the BBA, the IRS audited partners individually. Now, the IRS audits the partnership as a single entity. This means the IRS calculates adjustments at the partnership level, and they can assess what's called an imputed underpayment against the partnership. They do that instead of auditing each individual partner. The IRS can now collect tax directly from the partnership itself. This fundamentally changes how partnership audits are defended. So let's talk about the partnership representative trap. The BBA created a new role, the partnership representative. This is the one person who controls the audit. They get to communicate directly with the IRS and they make key decisions. Here's the problem. The partners themselves often do not have participation rights in the underlying audit. That means that one person can make decisions that affect everyone, including what settlement to make, what elections to make along the way, and decisions whether to litigate or not. The BBA audit process now includes multiple stages. It typically begins with a notice of administrative proceeding. Then the IRS issues preliminary audit findings, followed by a notice of proposed partnership adjustments. After that, the timing becomes very critical because there are strict deadlines to request modifications, to make elections, or to challenge adjustments. Missing these deadlines can permanently limit options. One of the most important decisions is whether to make a push-out election. If no election is made, the partnership pays the tax. If the push-out election is made, the tax is pushed to the review year partners. This creates complex economic consequences. Current partners may end up paying for prior year adjustments. That's unless the partnership agreement has actually addressed this eventuality. Most haven't. Why does this matter for individual partners? Well, under the BBA regime, partners face new risks, including unexpected tax liability, limited audit participation, economic disputes among partners, and compressed deadlines. This can turn partnership audits into governance issues, not just tax issues. So where we really shine is when a BBA audit becomes dangerous, where it potentially could go criminal. Most BBA audits begin as civil matters, but risk increases exponentially when the IRS identifies false allocations, fabricated records, intentional taxable income suppression, or inconsistent reporting. At that point, a partnership audit can become a criminal tax investigation. There's also state tax consequences here. Partnership audits also create state-level exposure. For example, California may require reporting after federal adjustments have been made, and state tax consequences can follow federal outcomes. This creates multi-jurisdictional risk, federal and state, and that increases the audit's complexity. So how do we go about defending BBA audits? Well, defending a BBA audit requires coordination. The partnership representative must control all communications. They must build a defensible record. They must evaluate all elections carefully. And they have to manage the partner expectation, because once a deadline passes, options narrow quickly. So in closing, if your partnership is under IRS audit or you're concerned about BBA exposure, early strategy matters. At the tax law offices of David W. Klasing, our dual licensed tax attorneys and CPAs help partnerships navigate BBA audit risks. Call 1-800-681-1295 or visit klasing-associates.com to schedule a confidential, reduced-rate initial consultation today, because early intervention can prevent significant partnership exposure. Thank you very much. Dave Klasing, Tax Attorney, CPA.